All right. Well, hey, everyone who's joined, we're just going to give another minute or two to kind of let people trickle in, and then we'll get started. All right. Well, it is 8 o'clock, so to respect everyone's time, I think we'll get started. I'm Jordan Fry with the Prudent Plastic Surgeon. I am excited to have Bill Martin here. He's the Chief Wealth Officer at Forme Financial, and they are a financial advisory group that specifically looks to help doctors. And they're also someone that I've partnered with. They've reached out to me, and we've spent a lot of time kind of getting to know each other. And I really do believe in what Forme is doing. I think they're doing amazing things. I think they're taking a very holistic approach. I think they are doing things the right way and are real, good guys kind of in this field. And so that's why I work with them, and I'm on their advisory board as well as a client of theirs, to sort of holistically look after my financial situation. So I was really excited to have Bill here, who is a real integral part of what they're doing at Forme, and he is going to talk to us about some important investment strategies and avoiding mistakes for physicians. And he's going to also put a nice tax spin on it, because I know we're all always looking to minimize our tax burden. So with that being said, I'm going to turn it over to Bill, and he's going to give us a presentation. Feel free to jump in if you have questions or comments during it, but afterwards we'll have some time where we can just have an informal discussion and ask any questions and kind of go from there. So Bill, I'll let you take over.
Thank you, Jordan, and I really appreciate everyone spending a few minutes of your time on a Thursday night walking through what we think is a really important topic for physicians. I'll go ahead and share my screen now and jump into the presentation. So you see the title here is 3 Financial Strategies to Accelerate Physician Wealth. And as Jordan referenced, 6-year in tax tips for physicians. Before kind of walking through the presentation, I thought it might be helpful just to share a little bit more about myself and my entry point into Forme Financial. So about 10 years ago, I found myself being rushed to the hospital with pain that just radiated throughout my lungs and through my back. It was relatively quickly diagnosed that I had bilateral pulmonary embolisms. And not that I knew, but at the time, my wife was told by the physicians, he may not make it through the night. And I would say through the skill and care of a team of amazing physicians, I am here this evening. And for me, when I think about physicians being the heroes of society, for me, they're truly the heroes of my own story. And that's my entry point, is thinking of why it's so important to do what we're doing on behalf of physicians. But then thinking about this, as I had a call that came in from John Clendenning. John is our CEO and founder of Forme Financial. And prior to joining Forme, John was the CEO of Charles Schwab Bank and Blucora. So I got the call and was interested in hearing what he was trying to build out with the founding leadership team. I've had a lot of experience in financial technology, as well as serving as a chief investment officer for a regional bank in which we were managing wealth on behalf of families and physicians. And to have the opportunity again to form a team in which we were basically having an opportunity to serve physicians, like I said, that are the heroes of my own story. It was an opportunity that I couldn't pass up. And as we walk through this, I hope the sincerity of which I'm sharing this, my own journey, comes through, but it also is really centered around the opportunity for us as an advisory practice to help add value and accelerate the wealth That's on behalf of the physicians that we serve. So I wanted to start off with some interesting statistics, and that is that many physicians dramatically underperform their financial position or their financial potential. So if you look on the far left-hand corner of this information, you see that despite being in the top 5% of earners across the US, there are a quarter of physicians that end up with about $1 million or less in total net worth at 65. Now, I would happen to say that if you're listening to this presentation and knowing the really good work that Jordan does through the Prudent Plastic Surgeon, that it's very unlikely that anyone would fall into this category. But another stat that's not on this page that is of interest is the average physician, when they hit retirement age, has about $3.4 million in net worth. Now, that may sound like a nice number, and it certainly is, but we believe that with some very smart decisions, that number could be substantially higher. And then moving on, another category that's of interest is that financial stress is the #2 cause of career burnout. And finding ways to reduce that stress, liberate physicians from those challenges, is really at the heart of what we want to do. And putting this all together, it's interesting having nearly 30 years of industry experience in working in wealth management, that I would say that us as advisors serving physicians have a lot at fault for not contributing more to the success of physicians. And I think looking at this slide helps kind of pinpoint what some of those challenges happen to be. So you take this example of Dr. Susan, and she has this team of financial professionals that she's working with, for example, like her wealth manager, insurance brokers, CPAs, employment lawyers. And the challenge is there's a very limited window of time to coordinate all this work, and maybe a belief that, well, certain things that the wealth manager do will just be carried over naturally by extension to these other parties. But that's not the reality. It's the reality is that Dr. Susan has to educate each of these counterparties in what's physician-specific issues and coordinate that work across a very limited and time-consumed work schedule. So unfortunately, because of this, we often find physicians like Dr. Susan end up underperforming their financial capabilities. I already referenced that the wealth management industry does have some challenges and is not in the best position to support, but this may, being the insider and having an opportunity to look at this, there are 3 structural flaws that I think are worth noting here. The first is that as an industry, we tend to be fatally incomplete. And it gets back to what I was saying, this lack of coordination across a myriad of advisors that are trying to serve the financial needs of physicians. And they often do this in isolation from one another. The second category is it's dangerously static. And what I mean by that, life is very dynamic. You think about the changes from one year to the next, but often from a wealth management perspective, what happens in working with physicians is there is advice delivered at a single point in time. And as life moves on, it's not proactive in nature. And so what is important at one stage ends up being challenging at the next. And finally, not rigorous. And this to me is an interesting one. Having known a wide array of financial advisors across the years, it is somewhat just the luck of the draw of who somebody gets to work on their behalf. And it ends up being that there's a high degree of variability. There's often a very generic approaches when you don't have the ability to work on a specialty such as the career arc that's a part of physicians. So at the heart of this, why did we build Forme Financial? We would clearly believe physicians deserve better. And to do so, we've built a comprehensive practice to serve the entire spectrum of the financial needs with the right people and the right technology. And here's an example on the screen of some of the technology that we put in the hands of the physicians that are mobile enabled, as well as technology that is a great way to stay connected with the advisor. So over time, the benefit ends up being wealth acceleration, which is the title of this presentation. And I think this sets the stage for when we talk about what are some key strategies to enable physicians to ultimately not just land at that average or the median net worth at retirement, but truly see an acceleration of their wealth during their entire career. And as probably many of you know, coming out of medical school, going into training, the net worth curve that you see here is negative. And what ends up happening is, compared to other professionals, it's often 10 years or more behind the earnings curve of where somebody else has had that window of time to begin putting those dollars to work. So ultimately, the challenge ends up being you have a shorter and more compressed time frame to make up that difference. And part of that is, what are those key strategies that enable physicians to see that acceleration over a compressed time frame? And so transitioning now to really highlighting 3 of these strategies that we are using with our physicians to help accelerate their wealth. You can see minimize headwinds, manage risk, and coordinating financial decisions. The first topic is one where I'm going to spend a little more time than the other 2. And the reason is there is a lot of headwinds that we face that are, to some extent, destroyers or drag the wealth that we experience over the life of our, during the arc of our careers. So the first headwind that I wanted to start with is thinking about the role that taxes play. Now, physicians, because of being among the top 5% of earners, find themselves in some of the highest tax brackets. What's not on this slide, but an interesting stat, is that the Medscape survey that was recently done of about 1,500 physicians found that the average physician is paying nearly $100,000 each year in federal, state, and local taxes. Now, that's the average, and clearly there's some that's paying a lot more than that, but that's not an insignificant number. And to think about, if there's ways to find opportunities to reduce that, I think it's going to be prudent for all of us to manage our tax opportunities in that way. Now, another interesting stat that's going to certainly happen as we move throughout this next year or 2 is the IRS is now in the process of actively recruiting 87,000 of your newest best friends. Now, as you think about that, you being among the top 5% in earners in the US, I would think physicians are going to be a likely target for the IRS as you move forward. So not only trying to find ways to minimize taxes, but to do so in a way that is audit proof, so to speak, is a really important strategy. So one way we found with our clients that have been able to do this is through the investment portfolio. This is a study that was done by Fidelity Investments. And it shows the drag that taxes have on annual returns over a pretty long period of time from 1926 through 2020. So equities or stocks, you see the average pre-tax return of a little over 10%, but about 200 basis points of drag is what's a part of the ongoing kind of management of stocks. So from an after-tax perspective, about 2% comes off the top just to pay taxes on those, managing those assets. And in bonds, you can see the same thing, 5.7 pre-tax and after-tax 3.6. So if there's a way to start shrinking that and leaving more dollars on the table for compounded growth over time, we believe that's an important way for physicians to accelerate their wealth. Now, I wanted to unpack a little bit here. This is a lot going on in this chart. And it's taking a look at some of the tax management strategies in action. So there's a concept that I wanted to introduce to the audience tonight that's called direct indexing. Many have heard of indexing and using passive investments such as ETFs or mutual funds that track the index as a smart way to invest. And I would agree, for those physicians starting out that maybe not have a lot of assets, or for those assets that are in retirement accounts where there's not the direct tax impact, that makes perfect sense. But in taxable accounts, we strongly believe there's an opportunity to add a lot more value from an after-tax perspective using this new concept of direct indexing. So take, for example, in this is the Russell 3000, or it could have been the S&P 500, is an index that tracks stocks across the US. What direct indexing does is it unbundles that. It's not just a single pooled vehicle, but you own a sampling of the stocks that represent that underlying index. So now that you have the ability to do some more innovative ways to manage those portfolios. What this chart is showing you here is the lighter blue line with the dots represents the annual returns going back from 2006 to 2021 for the Russell 3000. Most of those returns you see are above zero. So roughly 70% of the time, the market is up. Now, when the market is up, it's hard to do things like tax loss harvesting using pooled vehicles like ETFs and mutual funds to the same extent as if you had that unbundled and you owned, let's say, a sampling of 100 or 200 of those stocks that track very closely to the underlying index. And that is because as you look at each of these years, year by year, there's a good majority of stocks that are in the positive territory, but there's also a lot of stocks year by year that have negative returns. And by unbundling it, you can take the advantage of things like tax loss harvesting. So that is an interesting strategy that we are finding our clients deploy. And this next chart illustrates and highlights the benefit of this over a period of time. So I already mentioned there's about a 200 basis point drag that takes place in just managing an investment of taxable assets without applying these things like tax loss harvesting in a smart way. But if you were able to reclaim that 200 basis points, starting with $1 million taxable portfolio and having that continue to compound over time, you can see in this illustration, this bottom line represents what you would have if you didn't manage this in a tax effective way. So after the 20-year time frame, the $1 million continues to grow to a nice sum of somewhere between 2.6 and 2.7 million. But if you are able to leverage things like tax smart investing strategies, you end up generating another additional $1.2 million in wealth, making that nearly $4 million. It's a part of just starting with 1 million and leveraging some of this tax smart investing strategies. Now, you might say, well, this is easy to do. I can just do this at the end of the year. In order to capture this amount of value, you need to be continuously monitoring the opportunity to take advantage of this. So if you think about in 2020, the market was cratering when COVID hit, especially around March, April, and May. Now, often advisors or those that are doing it yourself, investors, are waiting toward the end of the year to do some tax loss harvesting and selling losses. But to do this throughout the year at a time like that was an opportunity to actually claim significantly more than 200 basis points in value. And at the end of the year, the market was up. The market ended up having double-digit returns in 2020. So those that waited to the end missed that opportunity of some amazing, call it the silver lining of the volatility of the market that's a part of that. Those opportunities end up are not easy to do. We have to, in order for us to capture it, there's very sophisticated and advanced technology that we're looking at on a daily basis to be able to see these kind of results for our physician clients. So,
Bill,
yeah,
sorry to
go ahead.
interrupt. Just a question based on that, just kind of while we all
Yeah.
have it fresh in our mind. So with tax loss harvesting, for anyone who's not familiar with that, essentially what you're doing is you're selling the stock or the fund you own while it's down, and then buying one that is similar or tracks similar, but is not substantially identical in the IRS's eyes, because then you get a wash sale where those tax advantages. So when you're doing it with these, individual stocks that you're holding on to as a collective rather than holding on to in just one fund, are you buying other individual stocks that are sort of also within that index and track along that index, or how can you go into that a little bit?
Yes. So the short answer is absolutely, that's what's being done.
Okay.
And there is an underlying optimization engine that allows us to understand, okay, what was sold, what's similar in kind of a risk signature and characteristic that allows us to do this. Another example, and it's kind of using the same technology, but a little different use case, is we often find investors and physicians that have worked with other advisors or done it themselves. Even though 2022 has been a down market, for the last 10 years, the market has been really strong and there's been a lot of gains that are in these portfolios. So there is one physician family that we were working with, just by way of example, that had a $6 million taxable portfolio. They were looking at transitioning this over. In order to move that to, let's say, directly to this direct index, it would have cost nearly $400,000 in tax liability. So their gains were much higher than that. Like, that doesn't make any sense to make that switch for a tax smart investing strategy, but shoot
Right.
yourself in the foot for doing that. So what we ended up doing is, through the sampling and optimization technology, able to find ways to hold on to those legacy positions that had low basis, and those that were at loss or those that were at small gains, kind of sell out of those in order to then take those proceeds and build now a customized, personalized direct index that tracked the particular market indice that we were trying to follow. What's interesting, we did that. The tax cost ended up being $2,000 as opposed to $400,000. And then we could do this on an ongoing basis. So that, what I'd say, that sampling and optimization technology is what enables to do it. But yes, a great call out. And and I would just add one more thing. So, because this has been something that we've had conversations with physicians that talk about, well, the benefit of tax loss harvesting is limited, because I can only carry forward $3,000 of those losses into kind of future use for the next year and the year thereafter. And there's a part of that statement that's true. You can only use about that $3,000 against ordinary income or earned income. But what you can also do is to carry forward the full amount to be offset against future capital gains. I'm going to come back to that because there's another story later on in this that's a case study that I wanted to kind of highlight the benefit of how kind of pairing that together with another financial decision ends up really generating a nice way to help accelerate wealth.
Great, thank you.
Yeah, no, absolutely. So let's move on. Still on the same topic of minimizing headwinds, but one that's certainly top of mind right now is inflation. There's a lot going on in this chart, but let me kind of distill it down to the few key points. The first thought is that the gray bars represent what an investor could earn during any of these given decades that are represented in basically a cash return. If they put 6 months, a 6-month CD, what could they get? So 1980s, you can see they would have earned about 10% on average on their cash balances. The other thing that I want to call out on this is the blue information, the blue lines, decade by decade, which represent headline inflation. And you can see, interestingly enough, in the 80s, on average, that inflation still was high, but it was substantially lower than the 10% cash return. So cash made sense as an investment. Just say that you could earn a nice kind of after inflation, a net return that was positive. And as you slowly move decade by decade out to the 2010s and then the 2020s, you see this start to reverse, where cash now, as we know, pays hardly next to anything, but yet inflation is moving forward very, 5% in this case on average for the 2020s, but much higher in 2022, as we all know. So as we think about finding ways to minimize the impact of inflation on portfolios to help us realize some of that benefit over time, I think just being really smart around management and use of cash. So as we're working with physicians, yes, the market's down, but there's ways to potentially opportunistically apply that cash and finding some ways that certainly have a higher degree of opportunity to earn an after inflation, after tax benefit, as opposed to just parking a big sums of money in cash. The other thing that's in here, what's another strategy that we've seen our physician clients use successfully, and that's around using real asset strategies. So that could be, for example, real estate. There's some private real estate types of investments that we have, access to that are really interesting hedges of providing opportunities against what I would say the eroding value of inflation over time. So you package these together, and I think you end up with some smart strategies to think about as you move forward that help really fight some of the challenges that inflation are providing right now against portfolios. On this slide, I just wanted to highlight another interesting kind of thought that maybe a lot of physicians and other investors would ignore, and that's really around the impact of high investment costs. Now, I need to reorient the audience on what this chart is looking at, because it's not showing cost, it's actually showing returns. So it's returns across different types of asset classes, from like bonds and stocks, very liquid types of portfolios, all the way to more what I'd say private capital strategies like hedge funds and other private equity type strategies that are out there. And the reason I pull this information in and how this relates to investment cost is looking at what I'd say the spread or the variation of returns between top quartile performance and bottom quartile performance. And as you look on the left-hand side, you see those spreads as being very, very tight. Like there's not a lot of difference between what those returns are year in and year out on average across these different highly liquid asset classes, like just stocks and bonds and other things. So for us, what this means, using an evidence-based approach, is it's really smart to minimize your investment cost in that part of the market. So things like the direct indexing strategy that I was talking about a few minutes ago, that makes a lot of sense. You don't want to pay a high active fee for when we know that there's not that much, call it potential alpha, that's in the market. Now, as you move to the right side, things like real estate or things like hedge funds or things like private equity, there's a higher spread between top and bottom quartile managers. And what is often the case is those managers that have had successful track records, there's some persistence in those opportunities to continue to move forward. And because of that, they often charge slightly higher fees than maybe the others in that category. So what we think is makes sense, if you're going to pay those investment costs, pay it where you have at least a chance of getting outsized returns. And those parts of the market where it's a lot tighter of returns, use those fee budgets wisely. I think that's a smart strategy for physicians to understand, because over time, just the headwinds of those investment costs continue to erode and chip away at the underlying value of the portfolios. So I'm going to now switch to the second wealth acceleration strategy, and it's really around managing risk. And I would assume the physicians on this call know that there are a lot of risks to have to manage as a physician, whether it's the malpractice side, or just knowing that people know that there's the potential of assets and income where you become a target of litigation and other things. We believe it's really important and prudent to find ways to have smart protection and risk management strategies as a mechanism to help accelerate and grow your wealth over time. So a couple of things that come to mind, you have asset protection and income protection as kind of the two main categories. As you think about the types of insurance that cover those, from an income protection, I think of this more as like disability and life insurance. On the asset protection side, there are things like property and casualty and umbrella, and even as you move out to more sophistication, things like trust strategies to put in place to help protect against, from an asset protection standpoint. What this is showing here is a life insurance analysis that we walk clients through to help them understand, do they have an adequate amount of life insurance protection for their family and for their needs? And what we often find is physicians tend to either be underinsured, or in certain cases, they might be overinsured. And it's really important to find what's that right amount of risk management strategies to have in place. And so it's often the case where we can find a way to maybe bump up those coverages amount to adequate amounts to fund all the things that are really important for their families and for their goals. And to do so at a rate, because in the case of Forme, we're not beholden to any sort of insurance carrier. We're really have the chance to look across an entire spectrum, which I think is an important thing for physicians to consider as they walk through this. Is there an opportunity to potentially get more coverage at even a reduced rate? Those are the sorts of things that we're finding. But at the end of the day, we do believe it's really important to have adequate insurance as a protection against, call it wealth decumulation, if you find yourself on the wrong side of that. And one quick story that I would have to share too, and I know as physicians, you see all the time, folks that run across unexpected kind of life events that maybe prevent them not from having the opportunity to practice medicine and they want, or to be able to do the things that they wanted to do. The same is true for physicians. And there's been some that I've encountered and had conversations with that things have come along to where they can no longer practice their trade. Maybe it was in an accident and had a hand injury and could no longer provide the type of surgery skills that they needed to continue moving forward. But with the right type of insurance disability, those things can help protect so that wealth creation opportunities still exist moving forward. So let me move on to the third one, wealth acceleration strategy by using a coordinated team. And I already referenced early on some of the challenges that physicians have of managing this army of advisors. And by coordinating these together, we believe there's opportunities to truly drive enhanced value and to see wealth grow at a faster clip when you have a coordinated team in place. One thing I wanted to highlight that I think could be of benefit to the audience tonight, this is a proprietary tool that we have that's called Forme's Fingerprint. And you'll see on the right-hand side just a snapshot of the graphical image that comes across when somebody walks through. It's about a 32-question process. It takes less than 10 minutes to complete. And it's a self-assessment of what I say these 7 main domains that drive financial wealth for physicians, ranging from investments, risk and insurance, cash management, et cetera. And it's interesting. So you get this snapshot of where you think you are relative to some of these benchmarks, and you get this report that shows where there may be opportunities based upon your own self-assessment. When we work with clients, this is a great starting point because it helps us to understand where there's potential pain points and working across these 7 key areas. But it also something that we found as we work through this is not always is the case where a physician thinks something is a challenge. They may be better off than they actually realize, and vice versa. So this provides an opportunity to do this. If you're interested, it's complimentary. Take your mobile phone, scan this QR code, and it'll take you to the location of where you can start and initiate this fingerprint process. What comes out of this is not only this image here, but a really nice multi-page report that gives you some information and key things to consider as you build this wealth plan for you and your family. So I thought it would be helpful to give just a couple examples of when coordination is done right versus when it is done wrong, and how that can contribute to what I'd say this wealth acceleration or lack thereof. The first example that I wanted to give is going back to if a physician has an opportunity to potentially sell a practice or sell a piece of real estate that in either case, maybe there's some long-term capital gains that's going to be associated with that particular sale. Now, often what's done is the CPA is informed of this. They begin preparing some things as relates to from the accounting profession. But what's not necessarily always done is then a linkage of that foreknowledge of a pending sale back to, let's say, the wealth manager that's looking at managing the portfolio of assets. But when coordinated well, here's an example of what can actually continue to add, a very nice amount of net worth to this from an after-tax perspective. So I mentioned earlier on about the tax loss harvesting, and those losses can be banked for future years against to offset capital gains. But through a coordinated approach, in this example I'm giving, what the physician could do with the knowledge of a couple of years, there's going to be a sale of a practice or real estate. There's going to be a pretty big hefty tax bill associated with that sale. If you can now at this stage begin to work on accumulating those tax loss harvesting as a bank to offset those future gains, that's a part of the sale. Through a coordinated approach like that, what ends up happening is what might be a pretty significant hit of 20, 30% or even more that gets pulled out just from a tax basis. You now have this bank that can offset that in a way to where that tax liability may actually be very, close next to nothing, depending on how much tax loss harvesting that you're able to do. Another quick example, though, I think of coordination when it's not done right. And the challenge that that represents is we've had conversations with physicians where we ask about from an estate planning perspective, are they in a good spot? And they said, yeah, I just finished up and we were working with our estate planning attorney, updated our trust and wills. We feel like we're in really good order. And as we probe a little bit further, what's interesting is as those changes have been made, certainly there's life changes that have taken place that are being reflected in these updated documents. If it doesn't flow through to say, let's say how assets are being titled, if it doesn't flow through to the right beneficiaries on insurance policies, there could be trouble waiting down the road when the estate begins to settle. And it really falls when it's not, and this coordination is not done well, it falls on the shoulders of the physician to have to kind of make those linkages across the different financial partners. And so I think the key takeaway here is, as you make these changes, understand these professionals are likely not going to pick up the phone, talk to the CPA, talk to the insurance broker, talk to your wealth manager. That's something that falls on your shoulder unless it's done in a really well coordinated approach. When it is, that's when all these things, assets transfer smoothly, taxes and other challenges are minimized, and it's an opportunity for that wealth to be preserved. So in the end, kind of summing this up, what we see in this concept of wealth acceleration is represented in this visual here. So we've talked about this unique kind of curve that takes place from a net worth perspective being negative during medical and training years. And as you move through this compressed time, and with the average physician generating somewhere of about 3.4 million in net worth at retirement. We believe with applying the strategies we've talked about and a few others that I just haven't had time to walk through, that there is a multiple of that wealth that can be accelerated and generated over time through making some really smart strategies. And this is the type of results that we're beginning to see and working with clients where there's these opportunities to really generate the success on behalf of the physicians. I'm going to stop there just for a minute because I think this is the short bonus section we wanted to hit with a few 6-year end tax planning strategies. I don't know, Jordan, if there's any questions that you have, or if I should just finish out with this and jump onto the Q&A. Sorry, unmute.
Sorry about that.
No
why don't we go through that? I know we have one question in the chat already, and then we can open up for a full Q&A. But maybe why don't we have you go through this, and then we can kind of do a Q&A over everything.
Okay, that sounds great. So what we have here are 6 different strategies that we think make sense for physicians to consider. They're not necessarily applicable to everyone, but some of these might be applicable to you. And especially as we get close to the end of this calendar year, these are things that make sense to kind of walk through and see if there's opportunities inside your own financial picture. I've talked a lot. You've heard about harvesting capital losses against gains. That's a strategy this year in 2022 where there's probably plenty of opportunities to take advantage of that. But to do so in a tax smart way in which we talked about where there's not wash sale violations and other things, I think is an important consideration. I'm going to jump down though. I won't go through the next 2 just because of time, but I did want to hit the final 3. And the number one deduction that physicians use, and it's overwhelmingly, it's by far the largest one compared to number 2 that's on the list. It's maximizing plan contributions, or to actually make deductions in these various things. So make sure that you have opportunities to contribute to your retirement accounts, 401ks, 403bs, 457 plans. Consider potentially using the Roth version of these as an opportunity to take advantage of multiple tax buckets. And the other thing is maximize this, not just put a little bit in, but this is an opportunity to truly see those assets grow over time. Now, if you're over 50, there's rules that allow for additional kind of catch-up contributions, which we think makes sense. So depending on where you're at this year, if you have a chance to do this, this is it seems like a no-brainer. You got to take advantage of this. And then the final 2 may be newer topics. Perhaps you've heard of them, but perhaps you haven't. and just wanted to highlight these two. And they're really both in the concept of using tax-free exchanges, parts of the tax code that allow for what's called basically like a swap of one thing that's kind of similar for something else, to do this in a tax-free exchange, whether that is an insurance product or real estate. So insurance is the 1035 exchanges, real estate is 1031. There's a number of rules and unique circumstances that's behind it, but just let's say you were interested in selling a property, but you wanted to continue to have exposure to real estate, and you didn't want to have to pay that tax right now. Well, this 1031 exchange is a possibility to do this. There's what's called Delaware Statutory Trust, or DSTs, as a mechanism to kind of help facilitate this. We think in certain circumstances, again, depending on the unique goals and objectives of the physician, this is something that might make sense to consider. And so with that, I guess my summary of all this is really just a big thank you to those that are part of this. Thanks for allowing me to walk through some of the tips that we are implementing on behalf of the clients that we work with. And we would love to have an opportunity to have a chance to interact with you, learn more about your set of circumstances, see if there's potentially a fit. We work across the United States. We have this opportunity for a free assessment. This QR code here is a way to kind of initiate that process. My email is also listed at the bottom of this, but we truly believe that physicians deserve better. Physicians have the opportunity to see substantially more wealth creation by using some of these smart strategies in action today and well into the future. So Jordan, with that, thank you so much. And, time for questions, I guess, if we have them.
Awesome. No, well, thank you so much. I think one of the areas you hit on that I think is super important of what you're doing is the coordination of everything. And that's something that I've benefited from because, we've spoke for a long time, myself and you and with the whole Forme team. And that's something that's benefited me. I did tested out the fingerprint. I found that for me, with estate planning and stuff like that, we were kind of behind. And it's pretty cool to see, again, I've experienced how kind of direct and honest you guys are. Even, you've said, okay, send me everything that you have in terms of insurance and let's see how it does. And it came back and you guys were like, look, you knocked it out of the park with insurance. You have good stuff and the price is better than anything we can get you right now. So just keep that. So I think that coordination has been something that I've really seen a lot and benefited from. And especially as someone that I feel like I am, pretty well researched on this stuff and I enjoy learning about finances. There are people who don't as much. And so having someone coordinating, even if it's not directly saying, okay, these are the things you invest in or whatever, is super, super helpful beyond the benefits of that. So that I just wanted to say that. And then I know, I think, Ricky, I still see you're on the call. You had a really good question about the direct indexing. Are you willing to come off and kind of ask it? Because I think you can probably put it into even better words.
Yeah, sure. Sorry for the background noise. Eating dinner right now at a restaurant. Thanks for
Oh, sorry.
Yeah. Yeah, thanks for the presentation, man. That was awesome. My question was regarding direct indexing. I just read that there might be a sort of limit to tax loss harvesting when it comes to direct indexing, where you become locked in and you've harvested so many losses. Now, each of the individual securities, you just sort of, after 10 years, harvested so much where the cost basis is so freaking low. There's nowhere else to go. It's never going to go down below the cost basis anymore. And in each of your individual securities within the direct indexing, is that a potential problem, or is that article that I read about it just like fluff? And if it's not really fluff, would this be a reason why you shouldn't direct index just for the fact of tax loss harvesting? Maybe you should really direct index because of tax loss harvesting. Plus, you can, get more control over the type of securities you want. Like if you're into ESG, but there's no perfect ESG fund. Could you comment on that?
Yes, I can. And I've seen similar articles. I don't know if you and I read the same one, but I think
Yeah,
it's
FI physician was the one I was. Yeah,
yes,
was I was
yeah.
I was quoting.
Um, and I would say this, the first comment would be, in the case of that physician that had $6 million portfolio with very low basis positions and being able to transition this over, and do so in such a way that we were able to truly take advantage of the tax loss harvesting opportunities. And so it gets I have seen this where you see maybe much more than even 200 basis points in kind of transitioning early years, with it beginning to tail off. And where it tails off just a bit is where there is kind of a continually market that's marching forward. Now, what I also find interesting though, is as you look at the variability of results year by year by owning those stocks, um, just by the nature of the market, you're going to encounter years like what we just had. You're going to see stocks that had performed incredibly well, um, that over time just get hit with a big, downdraft, and you have an opportunity to capture that loss. So I think just because of the variability that's a part of the nature of the market, that there's this ongoing opportunity to do it. Now, sir, it's not just this linear. I think that what the chart perhaps didn't illustrate, what ends up being the reality is it's not just, call it 1.5, 200 basis points year after year after year. There's years where you might see that be dramatically higher, and there's other years, depending on what's inside the portfolio, that might be smaller. Now, I've had about 20 years now that I've been doing this kind of work. It's part of the reason I got recruited in by John to be a part of this team. And what's interesting is the evidence that we could show is the ability through this past track record of working kind of similar things, where it wasn't just at the beginning that we were able to capitalize on this. This was multi-years and even into multiple decades where we found this opportunity. So even my experience in practice would suggest when you do this and do this with incredibly smart technology, which is hard to do yourself, this ends up creating opportunities that may have variation year by year, but over time, there still is enough benefit, we believe, to capture those kinds of benefits that I was highlighting. Now, you raise another interesting point that I didn't touch on that really is not so much about wealth acceleration and growth and using this, but it's direct indexing does allow for things like ESG. So for those environmental, social, and governance types of owning stocks that maybe reflect the values that are important to you, because you can do this in a customized way, you can own individual positions that might reflect those ESG values of yours and still manage what we call tracking risk or risk to the underlying market through optimization technology to create really a truly personalized portfolio that has some nice opportunities for not only tax loss harvesting, but to, like I said, reflect your ESG values and positions. So really good question. I don't know if that answers it entirely, but experience would show, and what my has been is, yes, there might be a tail in declining, but there's still plenty of value as the market gives us opportunities as we walk through year by year.
Thank you.
All right. Any other questions? You can type them in the chat. You can feel free to unmute and ask yourself as people are kind of thinking of some. I know the answer to this, but I think it's important to spell out, for you to answer it and to spell out what the difference is. So are you guys fiduciary? And can you just talk a little bit about what that means for people who may not be sure? Because again, as physicians, it's funny, we take a Hippocratic oath. We think everyone in life is, looking out for the best interest of everyone else. That is not always necessarily the case. So with that lead in, are you guys fiduciaries?
Yes, the answer is yes, of course. And it's the only way that I would want to do business, to where our interests are aligned with the clients. Now, what's interesting about this is, unlike other professions, let's call it, wealth management, where is this different? You think of CPAs or lawyers or medical professionals like this, there is clearly standards that you have to move forward. Now, there's some baseline test if you're a broker, a Series 7 or something they have to pass to say you can reasonably take a test, but there's nothing that's the equivalent of that. Now, what I'm beginning to see is more of a professionalization of our career, where things like the CFP, Certified Financial Planner, is a designation that's an important thing to have as you're working with clients. And so that is an area where, whether it's that credential, in my case, I have what's called a CFA. It's a more of investment focused, but it's an important credential. The credentialization of this, along with fiduciaries, I think are important considerations when looking for an advisory firm. Now, here's one thing that I would also point out, and I didn't get a chance to really get into this, but just because you're a fiduciary and you're looking at trying the best interest of a client, it doesn't necessarily mean that you're required to pick up the phone whenever there's something that might warrant a conversation with a client.
Mhm.
And I think for me, part of the reason that I left a job that was on a really good track to join this team is the technology that is being used to power alongside these fiduciary-based advisors. And so what I mean by that is by having a data-driven approach that's looking across all the things, whether it's from an investments or tax or estate, that can help surface through intelligent algorithms, things that are going to be proactively important. I think that just even heightens the ability to deliver really strong service in addition to this fiduciary-based principle. And so for me to partner, what I say, smart technology with fiduciary-based advisors that are proactive at looking at these unique life events based on data, that to me is, again, another really exciting part of why I joined Forme Financial. But it's a great question, and it's really hard at times, I think, as consumers to know, as somebody truly operating in that fiduciary capacity. I would say this one last comment is, just got back from a conference in which we had a chance to interact with surgeons in San Diego, and I was surprised. I'm beginning to hear more physicians just walk up and ask that very question. So there's some good education from folks like yourself, Jordan, of getting the news out. If you're working with an advisor, make sure they're a fiduciary, and we check that box.
Good. Ricky's asking, just to reinforce, are you fiduciaries all the time?
Yes.
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 All right. And so this is one, I think is important, and especially now as we see the markets are down. And I'll kind of preface it by saying, the way that I kind of split up my wife Selny and I, in any month, we have a savings rate of around 40 to 50%. Now, that I don't think is a necessary amount. I think 20% is a good rule of thumb. With that savings, about a third of it goes towards paying off debt, of which is student loans mostly for me. About a third of it goes towards investing in the market, which is it largely in tax protected accounts for me, and then a third of it towards investing in real estate, which is a big part of our plan. But what do you tell someone who's starting out and they say, should I pay off debt or should I invest? This is a broad question, and I'm asking you for a generalizable answer that is really kind of, needs to be personalized, but what's sort of the take there?
I believe there's a few key principles, and I like the way, Jordan, that you started off with your response, because more than anything, it's not which one is the right one to do, but it's more around how much are you saving that creates that momentum and opportunity for you to actually do those things in an accelerated way. So if you're only saving 5% of your income, you're not going to have a lot to either pay down debt or invest. And so I think that's the first principle I would put in mind is make sure there's a disciplined approach to this nice income level that's being generated, and finding ways to create that margin where you can do these things, because without it, you're kind of just handcuffed and you can't move forward. I would say, as a general principle, again, it's going to depend, but if there is an employer sponsored plan, like we were talking about from a retirement perspective, it makes sense to find ways to go ahead and get the employer match, at least as a minimum, because you're leaving those dollars on the table if you don't. And you're leaving that opportunity to see those dollars compound over time. I think another just smart principle too is if there's things like credit card debt or other just high interest rate things, start chipping at that away first before you look at maybe some other opportunities. But it is a personal decision, and it's personal based on even not just what the math says, but what somebody's preference happens to be. Is it really important for them to be debt free as quickly as possible? Or is it maybe more important to see, hey, I see this nice investment account growing over time? Not always a right answer, but the right answer, like I said, is just do as much as you can, like you're doing, Jordan. I think that's the secret to this question.
Okay, cool. And I think that's a cool thing I wanted to point out is when I, started working with you guys and talking about my specific plan, I said paying off debt is really important to me. And the money that I invest is almost completely at this point in tax protected accounts. And I didn't meet any resistance of like, oh, well, you should invest more, because frankly, financial advisors get paid more the more you invest. It was okay, let's talk about exactly about your debt payout plan and make sure that we're meeting your goals. And I thought that was very cool. We're getting to the end. We have a few more questions, so we'll do this in sort of a rapid fire manner. But so Jason's asking, does your company have CPAs, lawyers, financial advisors, tax experts, etc.? Meaning, like, are there experts in all of these disparate fields kind of available, making it sort of a one-stop shop?
What we do is coordination among all those teammates. So at this stage, and we'll continue to add teammates that have, let's say, a CPA, for example, or an attorney. But right now, what we've done is struck partnerships in which we get the benefit of economies of scale. We've worked with partners that know very clearly around how to maximize opportunities with physicians and do this in a very coordinated way. But with that said, each of our financial advisors that are part of our team truly are experts and physicians, not just in managing the portfolio, but in things like tax planning. And to me, that is ultimately as important as tax preparation, for example. We can also do, as you were referencing earlier, Jordan, an estate planning review that just takes a look at the documents, provides something back that shows in a very nice, visually easy to understand way of how everything flows, and to make sure it's all in a good order. But we use a partner to help provide that integrated service. And so the other thing I would just say is we do find it's helpful to be able to work with these type of partners, but we're flexible enough if somebody already has a CPA, for example, that they're working with really well. We want to be a great partner. And so we're not wanting to do our piece in isolation. We're wanting to do this in a cohesive way. And so we work really well with independent and third-party practitioners as well. And as I said, over time, we're going to probably bring a few more of these specialists in-house, but right now we feel very confident with the partnerships that we have in place.
Cool. And then Ricky's asking, so what do you find is the biggest financial mistake doctors make? Is it A, spending too much, B, no debt plan, C, buying whole life insurance, D, no written financial plan, or E, living in New Jersey, which I know he lives in New Jersey. Although I'm pretty soon I'm feeling like I'm going to see that Ricky's moved to like Puerto Rico or something where there's like no taxes. All of these of which he has made, and aside from living in New Jersey, I have made at some point, and buying whole life. I never bought whole life. But so what's like the most common one you see?
I would say I've seen all of the things that Ricky pointed out. I think I would start with this. It's really around not having a well-organized plan. It's not that somebody hasn't thought about, oh, I want to do some investments, or I haven't gone and made sure I'm working with a really good CPA, or I haven't started work on building out kind of an estate planning process. But to do so in a very focused, what are the goals and objectives? How can we do this to really optimize the opportunities that are part of this? I think that's where we end up seeing really the failure to have what I'd say that cohesive strategy across this team. And that ends up having what I'd say many of these missed opportunities that we've talked about on this call.
Awesome. Well, Bill, thank you so much for your time and sharing this education. Everyone on here, thank you so much for spending your time. And I hope it was as enjoyable and informative as it was for me. Bill's information is here. Obviously, if you want to get in contact with me, feel free to email me, jordan@prudentplasticsurgeon.com. And so thank you again, everyone. Have a good night.
Many thanks. Take care now.